In this video, I'm going to talk about the equity account, common shares, and so forth, the accounting, and how these equity accounts come about and how we account for them, okay? So let me just start with a very basic, simple example. An individual starts off with a private company, and that private company has been in existence for various years, and here's the company's balance sheet as a private company. Okay, so it says owner's equity here instead of shareholders' equity because it's a private company. So this individual feels that they can take he or she can take the company public, which will permit them to go ahead and get funds for the company in order to grow, right? So they solicit to turn public with the state, and the state gives them authorization for a certain amount of shares. Let's just use the term state gives them authorization for 7 million shares. 1, 2, 3, 1, 2, 3. Okay, so 7 million shares have been authorized right here as of December 31, 2016. The company becomes public with 7 million shares authorized. And let me go ahead and move this to the side. And the current owner represents his or her shares with 1 million shares of common stock, 1 million shares of common stock booked at the $1 par value of the stock. Okay, each share has a $1 par value. Okay, so each stock is going to have a par value. That's the face value that each share has. It's a bit of an outdated concept. When the shares are sold out in the initial public offering, that number typically is not what the companies receive. They typically receive a lot more than the $1 par value. Okay, that's just an outdated concept. Companies in the past were required to give their shares a specific par value, and that would be the equity that they could not distribute out to shareholders. Okay, that would be the minimum equity that the company was required to have. And because of that, companies try to bypass this liability by issuing shares with very, very low par values, usually in the dollar or the 50 cent or in the cents. So you're going to see shares with very low par values. And this concept is outdated. I'm not going to get too much into it. Okay. But anyways, now the company is public. The owner of the company, when the company was private, represents his or her ownership with the 1 million shares of common stock, which are equal to the 1 million shares outstanding. At this point, that owner is 100% owner of the company, right? This example, by the way, is unrealistic in many ways. Okay, so let's not focus on specifics. It's just to show you the mechanics of how the equity accounts come about. So 1 million shares are outstanding, right? So we have 1 million shares issued. We have 1 million shares outstanding, right? Which equals. And therefore we have 6 million shares that are unissued. Okay? Be familiarized with these terminologies here and these classifications of common shares. Okay? So at this point, the company has 1 million shares issued, and so forth. But the purpose of going public is to raise funds, right? So the owner is going to take some of these unissued shares and sell them to the public in general, right? So an IPO is initiated, an initial public offering is done, and at that point, 1 million shares are sold at $5 each. Now remember that the common stock has a par value of $1, okay? So how do we record that? Well, the company is going to receive $5 million in cash from outsiders, right? You're going to put the par portion over here, which is going to be 1 million, right? They sold 1 million shares at $1 par value. So common stock account is going to have a balance of $1 million. And since they received 5 million, there's going to be an excess, an additional paid-in capital of $4 million. So $5 million represents the total paid-in capital from this transaction. We're subdividing it into these two categories. Common stock has the portion that relates to shares. Again, how do I calculate that? That's 1 million shares, right, times the par value. In this case, the par value is $1, so it's going to be $1 million. Okay? Now, the outside shareholders now purchased the stock at $5, so they paid $4 over par. So that calculation is very easy, right? 1 million shares, again, times the $4 over par that they paid. And the $5 million come into the company, right? So now we come over here and we add the $5 million to the cash. Now the company has 5.1 million, which belongs to the shareholders, right? So now common stock is going to have another 1 million out here. And we've created a new category called additional paid-in capital. Sometimes they say paid-in capital excess of par, paid-in capital over par, additional paid-in capital. Any of those terminologies is correct as long as it makes sense, right? So additional paid-in capital is going to be $4 million. Okay, notice how my assets match my liabilities plus equity, because the 5 million that we added here was also added down to the equity side, and so the accounting equation remains in balance. Okay, these two accounts are the two paid-in capital accounts, right? They're the money that shareholders pay in. They put them in from their own pocket. Okay, so obviously if you put the money in from your own pocket, that portion belongs to you, right? As opposed to money that would have come from a loan that may increase your cash balance, but it's a liability because it came from somebody else, right? You owe that money to somebody else. In this case, shareholders that when you sell shares out in the market, brand new shares, when the company sells its shares out in the market, they bring in new shareholders, and so the equity account goes up, and of course it's paid in cash, so the cash goes up. Okay, notice how common stock and paid-in capital have a credit balance. Okay, just like liabilities, so they go up with credits. Over here now we have 2 million shares outstanding. Okay, so now the original owner is only 50% owner of this company, but actually the original owner now is a lot richer, right? 50% of $6 million is $3 million, whereas before the owner had value of $1 million. So the owner got an extra $2 million. Why? Well, because the market paid a lot more for the 50% share that he or she sold, right? They paid $5 per share, not the $1 per share that was initially estimated in this equation, right? So the original owner is 50% owner of the company with 1 million shares. Outsiders are also 1 million, 50% owners with 1 million shares. And so now the company is a publicly traded company. Typically, the original owners don't keep such a large amount of 50%. Again, these numbers are not necessarily realistic. I just want to show the transactions that occur. Okay? So that's the first entry related to stockholders' equity. So the year goes by and the company does various transactions. Okay, again, this is unrealistic. This is just going to represent a full year's transaction. Okay, obviously a real company would have thousands and thousands of these transactions, maybe even a million, maybe even in the millions, right? But I can't put a million transactions here. So let me just put 4, and let's see how this affects my equity account. Okay. Company sells some of its inventory for $80,000. They receive $50,000 in cash. Actually, okay. Well, I was gonna put this entry over here on this other side. Let's just put it here. Let's just put it from the beginning. Okay. They receive $50,000 in cash, and they're due $30,000 from the individuals that purchased this inventory. Okay, they're going to recognize the cost of that inventory as cost of goods sold, and your inventory goes down by $50,000. Right. Subsequently, company collects some cash here, and so that lowers the accounts receivable. And then the last transaction shows that the company had got their utilities expense bill of $5,000 and that they're going to eventually pay it, but that $5,000 pertained to this year. So let's see how this affects equity. Okay, as you start working with okay, let's move over here. Okay, so let's see, could I go a little bit further? Let's see. No, let me see if I could go ahead and, well, let me just leave this like this. Okay, so as we start putting these accounts, the company received $50,000 in cash, so this is going to increase cash over here by $50,000. 50, 1, 2, 3, let's add $50,000. So we took care of that one. Accounts receivable is going to go up by $30,000. $30,000. That one has been adjusted. Sales revenue is an income statement account, right? $80,000. So I'll put it here in my income statement. Sales revenue. That's my first revenue for the full year. For the first full year, $80,000. Cost of goods sold. That's another income statement account. So we put it over here. So the gross profit for the company was $30,000. Inventory. Inventory is an asset. It goes up with a debit. So in this case, it went down with a credit, right? Because we sold inventory. So let's bring inventory down by $50,000. Okay. Here we collected some of the receivables. So cash went up by $10,000. I'll bring it up by $10,000. And accounts receivable goes down because we collected the $10,000 in those receivables. Okay. Utilities expense that's an income statement account, so we recognize over here. And accounts payable is a balance sheet account, a liability. So we bring accounts payable up by $50,000. Okay. So, and I probably should have put this transaction over here. Let me put that transaction over here. Okay, let me go ahead and put it over here. I'll bring this back to the okay. 500,000. Okay, so this is what we had with 1 million shares outstanding. And this transaction, I'm just gonna go ahead and move it over here. Let's my cash went up by 5 million that I received, right? My common stock went up by another million that I sold, and my additional paid-in capital went here. Okay, so now I go ahead and my outstanding shares went up by 2 million. Okay, so this is how I started as a public company. I did various transactions. Among them, the transactions that I did, I sold some common stock, and we see how that affected my common stock account, right? Common stock went up by 1 million. Additional paid-in capital went up by 4 million because I sold 1 million shares at $5 each, right? Which brought my cash up by $5 million, okay? And if I come over here and I look at this, let's take a look at this, okay? Did I miss anything here? Yes, I forgot to put the accounts payable went up by $5,000, okay? Accounts payable went up by $5,000. Okay, not 50. I had made a mistake there. Okay, so if I look at my balance sheet at the end of the period, I see that my assets equal $7,530,000 and my liabilities plus equity equals $7,505,000. Now, you know that these two numbers are supposed to match. So why are we off? The answer is very simple. Your company created an additional $25,000 in net income. That's incremental value that the company created for its shareholders, right? The company used $55,000 in expenses, right? $50,000 in inventory and another $5,000 in utilities to create $80,000 in revenues. So the company created for their shareholders an incremental $25,000. That's the whole purpose of every company. The balance sheet is something that you never close to zero, right? It's never blanked out. You leave it the same because this represents what the company has. But the income statement is zeroed out, right? Once you have your income statement, you want to start, for 1 year, you want to start the next year. So, how do you close this income statement account? You're going to transfer this net $25,000 over to retained earnings, okay? Retained earnings. So retained earnings is the money, is the value that the company created for its shareholders in the form of net income, revenues minus liabilities, okay? So revenues have a credit balance. If we put a debit, we'll close the revenue. Cost of goods sold has a debit balance. We'll put a credit to close cost of goods sold. And utilities expense, an expense account has a debit balance, and we're going to put a $5,000 credit balance to close utilities. This is the closing entry. This is going to close my income statement out to zero so that I could start a new year with zeros in this column so that I could, my subsequent year, I start accumulating new revenues and new expenses, okay? And in essence, I transfer that over to retained earnings, okay? So this is how we transfer the net income to retained earnings. We close the sales revenue by putting an entry opposite from its normal balance. We close the expense accounts by putting, expense accounts typically have debit balance. We're going to put a credit balance to close the account to zero. And the plug, which is going to match net income, we put it into retained earnings. Okay? So now retained earnings is going to be $25,000, and it should match. So I'm missing something here, right? Let's fix this formula. So if I put it over here, it's going to match. Total assets equals total liabilities plus stockholders' equity, okay? So now you know how we came about with 3 of the shareholders' equities account, right? The paid-in capital accounts, which are common stock and additional paid-in capital, come about when stock is sold. When the company sells stock to outsiders, new shares, right? I have to adjust this here, right? So now we have 2 million shares outstanding, 2 million shares issued, and I have 2 million shares outstanding, and I have 5 million shares unissued, okay? So now we're ready to start the next year, and you go ahead and you print this income statement and you distribute it to your shareholders as is. With this entry, you're going to go ahead and zero these out, and you're ready to start your new year, the following year, 2018, with an income statement of 0, okay? And you continue to build net income, and you continue to accumulate retained earnings. That's the whole purpose of a company, right? To accumulate retained earnings and to grow. Retained earnings represents the value, the earnings that the company has made, extra incremental earnings that accrue to the shareholders, okay? So every once in a while, some of that retained earnings is paid out. So let's go ahead and let's fast forward to the year 2025, okay? 2025, the company has done very well. The balance sheet, the income statement, and everything else has increased dramatically, as you can see. The company has retained $3.4 million of the money, of the net income that it's made. As you can see, retained earnings has grown. Common stock and additional paid-in capital has stayed the same. What that tells me is that the company has not issued any more shares, right? They're the same as 2017. But throughout the years from 2017 to 2025, it's continued to make profits, and all those profits accumulate in retained earnings, right? Once a company has made profits, sometimes it wants to distribute some of its profits to its shareholders, right? In the form of dividends. We call that dividends, right? So let's take a look at this example over here. It says that on January 5, 2025, the board declares a cash dividend of $1 per share, okay? So they've declared a cash dividend of $1 per share on January 5. They haven't paid it yet. They've just declared it, okay? So on that day, they've declared it. Therefore, they have a liability. How do you record that liability? Here's the entry over here. When the dividend is declared, you're going to immediately why is additional paid-in capital over here? This is not right, okay? Okay, this should not be there. Okay, so let's do the calculations. Okay, so the calculations say we've declared a dividend of $1 per share, and there's 2 million shares outstanding. So companies pay out of retained earnings, right? Retained earnings has a credit balance. So since they're going to pay out of their retained earnings, that means they need to lower their retained earnings by $2 million. That's the amount that they're going to pay. They're going to pay $1 dividend to 2 million common shareholders. Okay? That should be 2 million there. Okay? Because there's 2 million shares outstanding. We haven't paid it yet, so we're going to put it under dividends payable. Okay? Then it says, these are payable to stockholders of record on February 5. What does this mean? Well, when you declare a dividend, you have to say who you're going to pay it to. So you got to specify which shareholders, because shares trade hands continuously, right? So there's a specific date of record that's stated. to whom that dividend is going to be paid. And that's just for information purposes, right? So that the shareholders know. So the date is February 5. There's no entry that you have to do for this. This is just for information. The date of record says who's going to receive the dividend. And in this case, it's the individuals that hold the stock on February 5. Again, no entry necessary. Okay? And then it says the dividend is paid on March 5th. So the date of payment, March 5th, you are going to close your payable account to zero and you're going to pay with cash, okay? So as you can see, when a dividend is paid, it's paid out of retained earnings, right? So retained earnings now is going to go down by $2 million, right? And by the way, companies can only declare dividends if they have enough cash and if they have enough retained earnings. They must have enough of both of those, or else they will not be able to pay, they will not be able to declare a dividend, okay? And over here, we could go ahead and we could put dividends payable would go over here, right? At that point, you're going to owe some dividends payable. We go ahead and we create that account for $2 million, right? And then in this very next transaction, you close your dividends payable account. So that goes back down to zero, right? Let me just reverse everything I did. So you paid it. So your dividends payable account no longer exists. And you sent $2 million of cash out, okay? So your cash goes down to $6 million, okay? So notice how my retained earnings went down by $2 million because I paid $2 million in dividends. And whenever you pay dividends, you pay out of retained earnings, okay? So the two major categories in shareholders' equity are paid-in capital, which are these two, and retained earnings, okay? There's other categories, but those are the two biggest categories of shareholders' equity, okay? Now it says, on June 1, 2025, 500,000 shares were repurchased at $8 each. Okay? So the company repurchased from the market 500,000 shares. Okay? And they repurchased them at $8 each. Okay? 500,000 times 8 is $4 million. Sorry. $4 million. So that's the amount the company repurchased. So they're going to use the treasury stock method. You could also retire shares. I'm not going to explain how to account for that. That one is a little bit more complicated. But using the treasury stock method, meaning that they're going to keep them as treasury shares, you simply pay your cash out of $4 million and you book the treasury stock here. Now notice treasury stock has a debit balance, right? As opposed to most other equity accounts that have credit balances. That's because treasury stock reduces the amount of equity that you have, right? $4 million of treasury stock. So you're going to put treasury stock here in negative, okay? Minus 4, 1, 2, 3, 1, 2, 3, okay? And we need to include it over here, right? Let's use the accounting way of doing it in parentheses. Okay? So notice that we have $10.5 million here, and we need to take away the $4 million that we used to purchase those treasury shares, okay? So the accounting equation is still in balance, okay? And shares outstanding, well, we reduce the shares outstanding by 500,000. This equals 2 million minus 500,000. Now we have 1.5 million shares outstanding. Okay, I'll put the treasury shares here. Let's go ahead and put them in parentheses. Well, I'm not going to put them in parentheses. Let's just put it. So 500,000 in treasury shares, right? Now the outstanding shares is 1.5 million. Notice how issued stays at 2 million. The company has issued 2 million shares. But since they repurchased 500,000 in treasury shares, that means that the shares that they have outstanding is 1.5 million, okay? So they have a total of 7 million shares that were authorized way back in the beginning. They've issued a total of 2 million, which means they have 5 million unissued. Of the 2 million, they repurchased 500,000, which means that they have only 1.5 million outstanding at this point, right? So shares outstanding equals shares issued minus treasury shares. If you don't have treasury shares, then shares issued and shares outstanding is going to be the same thing, right? But in this case, we have 500,000 treasury shares. So shares outstanding is going to be $1.5 million, okay? So let's summarize this small section on shareholders' equity, okay? When equity is issued, the par amount is put under common stock, right? Equity accounts have credit balances, okay? So in this case, the company sold 1 million shares for $5, right? 1 million shares for $5 each. And each share has a $1 par value, right? So under common stock, you're going to put the par portion. 1 million times $1 is $1 million in par value. The remainder, the excess that was paid, the new shareholders pay $5, so they paid $4 over par. Goes under additional paid-in capital, okay? These are the two paid-in capital accounts, and this represents the money that the shareholders put in themselves, okay? Another account that's created in the equity section is retained earnings. What's retained earnings? Retained earnings is nothing more than the incremental value the company has created for its shareholders, otherwise known as net income, right? The purpose of a company is to take X amount of assets and use them. So in this case, we use $50,000 worth of inventory and $5,000 worth of utilities, and the company created $80,000 in value, typically cash, right? So the company created a net value, which we call net income, of $25,000 for its shareholders, right? That increases the shareholders' equity. That goes down into the retained earnings account. How do we get that there? Well, we get it when we put it there when we close the income statement account to start the next year. We close it by putting the opposite balance in revenue, right? Revenue has a credit balance, so we close it with a debit balance. We close cost of goods sold, which typically has a debit balance with a credit. We close utilities expense, which has a debit balance with a credit. And there's going to be a difference, right? Just like here, there's a difference. That difference is put into retained earnings. And that's how you create the retained earnings account. Another equity account is treasury stock. Treasury stock represents the stock that was repurchased by the company, right? So in this case, the company repurchased $4 million worth in treasury shares. So they're bringing that money in. That's why treasury shares have a debit balance. They are a contra account. And they lowered the equity balance account. In this case, the $4 million that was repurchased lowered the shareholders' equity portion by $4 million. I probably should have put a subtotal here. Don't know why I didn't do that. But I probably should have put a subtotal here, right? So it lowered the equity portion of the shareholders by $4 million. Okay. Another thing that we learned is that dividends are paid out of retained earnings, right? So when you declare the dividend, you go ahead and lower your retained earnings. If you haven't paid it, you simply put it in dividends payable. Once you pay it, you close your payable and you pay the cash, okay? And all that is going to affect the balance sheet as I showed here, okay? So for the test, learn the different classifications, learn how a very simple entry is made when a company sells shares. The two major classifications of shareholders' equity, which are paid-in capital and retained earnings. There's other things like treasury stock and so forth, right? How does retained earnings come about? Well, retained earnings is nothing more than the net income that the company produces which is retained, and that belongs to the shareholders, so it increases their equity. Okay? If you don't close your net income account, your balance sheet is not going to balance, right? Assets are not going to equal to liabilities plus equity, as we saw in this example. If you don't remember, rewind the tape and you'll see that. Okay? And so that's pretty much it. Stockholders' equity is a lot more complex than this. This is just a very basic explanation of stockholders' equity. Like I said, it's a lot more complex than this, but this is enough for you to know to pass the test, okay? Thanks. I also forgot to add very quickly this last step here, stock split. Okay, so let's take a look at stock split. It says December 1, 2025, a 2-for-1 stock split was executed. So there's no entry necessary for stock splits, okay? Over here, typically what you're going to get is a note. And in that note is going to say something like, let's say, it's going to say 1,500,000 shares outstanding, right? Shares outstanding at $1 par. Okay? So when, unfortunately you can't see all of it there, but let me just come over here and show an example of what the note would look like. Okay? So it would look something like this. Something like that, right? Following the paid-in capital, it would say 1,500,000 shares outstanding at $1 par, okay? So once a stock split is done, none of these values are going to change at all. Instead of having 1.5 million shares outstanding, you're going to have 3 million shares outstanding, right? Because you did a 2-for-1 split. And the par is going to be 50 cents, okay? So a stock split requires no entry at all. It simply requires an adjustment to your little note here, your parenthetical note. If you have 1 million shares outstanding at $1 par and you did a 2-for-1 split, now you're going to have 2 million shares at 50 cents, right? Notice how 1,500,000 shares at $1 par is the same, it's going to give you the same common stock value as 3 million shares at 50 cents. Okay? So that really doesn't matter at all, the par value of common stock. Okay? So don't, no entry related to stock splits. You simply adjust the parenthetical note as far as number of outstanding shares, and the par value, you adjust it accordingly. Okay? Thanks.